China declares an emergency. I'm Steve Van Metre. New orders are crashing, home sales are collapsing, and banks are hemorrhaging. It's China's warning to the world that global chaos has begun. Now, let's over to Bloomberg, where he picked today's story up with the headline. As China manufacturing slumps on U.S. levies, spurring stimulus calls, it's an all-out emergency now for China's economy. And when you think about this trade war and tariff war, why it's going to have such an impact on China's economy before everyone else is because they're the world's largest exporter. So when pain comes from an economic standpoint, they're going to experience it first. But the problem is, as you're about to see, it's going to spread all across the world and even here to the U.S. The official Manufacturing Purchasing Managers Index fell more than expected to 49 from 50.5 in March. The non-manufacturing measure showed activity in construction and services grew less than forecast. And I want to understand why manufacturing is so important. It's because the jobs are usually higher paying, and when manufacturing slows down, it impacts the services sector usually within a few months. Now, an issue for China is construction because they employ a large number of people in their real estate sector, but the problem there is real estate prices are crashing and the labor market's starting to unwind. And when that happens, people don't buy homes. In fact, it gets even worse because they start to enter delinquency and then default. And as you'll soon see, their banking system is right on the edge of collapse. It's definitely worse than expected. It shows tariffs started to bite. This from China's chief economist at Morgan Stanley. He forecast a significant economic slowdown this quarter that could trigger more stimulus. Now, here's the key part, is this is already happening before the tariffs went to full strength. And this is an issue because we've seen this not just in China's economy, but we saw this here in the U.S. data as well, that there was all this front running of tariffs. And the expectation is we should have seen these PMIs surge, but they barely moved. And in China's case, it contracted on the manufacturing side. And this is a major red flag because what it indicates is not just China's economy, but the entire global economy has been slowing down. And when we see the full impact of the tariffs, well, what just happened in China in March? Well, that number is likely to plunge and in a major way. New export orders fell to the lowest since December of 2022 and recorded the biggest drop since April that year, back when Shanghai entered a citywide pandemic lockdown. A subgauge indicated that employment in the manufacturing sector contracted at the worst pace since February last year, adding pressure on authorities to stabilize the job market. And believe me, this is an absolute crisis for China because unlike the United States and other countries, they don't have unemployment insurance. So when people lose their jobs, their income goes to zero, and that means their spending is going to drop. That means their desire to invest in real estate. In fact, their need to perhaps sell their properties because a lot of people in China actually speculate on the real estate market. So you can see this adds downward pressure to the property market, which is highly leveraged by the banking system. So if we see property prices there continue to fall, well, it's going to margin call their entire banking system. But we can talk about new orders because it's absolutely critical for any manufacturing sector because it's a leading indicator. To give you some perspective, let's look at some U.S. data. We have manufacturers' new orders of durable goods in blue shown against the unemployment rate in red. And we can go back to 2000 and we can see the slowdown in new orders already began and then entered a contraction. And you can see as demand for new orders fell, what happened is you saw manufacturers start to lay people off. But because it was a broad-based slowdown, there was no opportunities for those workers to find other jobs. And we were right into the dot-com bubble. Let's move forward around 2007, we're seeing a slowdown in new orders that eventually contracted right in the middle of the financial crisis. But you can see as demand slowed down and new orders started to slow, also demand for the labor market fell apart, putting people on the unemployment line and sending this right into the financial crisis. We can see going into the pandemic, a slowdown and a contraction in new orders impacted the labor market, and we can see it's happening now. In fact, we can go back to 2021. We can see the slowdown in new orders led to a bottoming of the unemployment rate. And despite the fact we saw a massive upshoot in new orders, what happened is rather than hire people, manufacturers went out and they gave their existing workforce more hours because they knew things were going to slow down and in a major way. But just because we're seeing the PMI starting to crash as the trade war goes full force doesn't mean your trading account has to go down as well. We told our Momentum Timer Pro subscribers to buy Bitcoin or GBTC back on the open of the 14th. How did we know that? Well, we saw the technical indicators and the trend rising, and as of close of business yesterday, the trade is now up over 12%. And here's the best part: you can join us on our next big trade. All you have to do is grab the links in the description below, use a coupon code for your free 30-day trial. Stay tuned to the end of the show for more information, because let's turn back to China, where things are only set to get worse. To help ease the pressure on exporters, Beijing this week laid out plans to help struggling firms access loans and to boost domestic consumption, but stopped short of announcing more aggressive economic stimulus. Instead, officials are focusing on executing the stimulus package approved back in early March. The problem is, we continue to note that stimulus in China doesn't work. But I want you to see what they're doing with the banks here, because this is really important. All they're doing is what's called extend and pretend, or give people more loans. And that's not going to solve the problem, because right now global demand is plunging. We see that in not only in China's export data, not only in their new order demand, but we see it all across the world. And this is a problem, because giving a dying company more money isn't going to solve the problem. In fact, it puts the banking system there at greater risk for failure. The same issue from consumers. If they don't have a job, why would you give them a loan? And if you did, why would they go out and spend it? If this makes any sense to you, what China is doing, weigh in the comments, because I don't think it's going to work at all. And even before the 145% tariffs, China's industrial and manufacturing firm were already struggling, with profits in the first quarter up by only 0.8%, far below the GDP growth rate. And that was something we already knew, that the tariffs were literally going to push the global economy right off a cliff into a recession, because we already saw signs of this in China. We already saw property prices were falling. We already saw new order demand was down. We saw consumer prices were already entering deflation. Producer prices were already in deflation, so all signs were pointing to China's economy slowing, and what we're finding out is the trade war is just a nudge to perhaps push them over the edge. But what China's warning about is what's happening to them is going to spread all across the world. And here we can see why new order growth is absolutely critical for the manufacturing sector, because once you see new orders drop and your backlogs are gone, well, that means you lay people off, and that's what we're starting to hear is happening in China in a major way. And you can see exactly how it leads the headline number. Where new orders go, the headline print will follow. That's why we know starting next month and the months that follow, as long as this trade war persists, what's coming for China and the rest of the world is going to be all-out chaos. It's going to impact China's property market as we see new home sales slump persist as U.S. tariffs take effect. And despite the fact that Beijing pumped a massive amount of stimulus into the property market, we said it wouldn't work. And now it's set to get even worse, because again, keep in mind, the banks are highly leveraged with a lot of loans to the real estate developers. And think of this: if prices crash, it could margin call the entire Chinese banking system. The value of new home sales from the nation's 100 largest developers fell 8.7% from a year earlier, following an 11.4% decline in March. April sales were down 10.4% from the previous month, and you can only imagine, as more workers in China lose their jobs, that means demand for new housing is going to fall. And again, we think back to what Beijing did, because you want you to understand that people buy homes before they're completed there. So Beijing came out and stimulated, put a lot of money in the banking system, and forced the banks to lend to the property developers so they could get some of these homes completed. And now what they're finding out is their economy is headed into recession, demand is plunging, prices are plunging, and the banks are going to go. Beijing has struggled to turn around a weak property market with absolutely no success. Now is in its fourth year of decline, and that has weighed on broader consumption and employment, and that's really critical because their housing market does employ a lot of people, and unless they're buying and speculating on homes and driving prices up and buying even more, well, it puts even more Chinese workers out of a job. And here we can see, looking at some U.S. data, just how critical property markets are to an economy. As we look at new privately owned housing starts in blue, gives the unemployment rate in red. And what do we see? Going back in even to the 50s, a slowdown in housing starts put people on the unemployment line. We see it happen going into the 1971 recession and the 74 recession. The same thing happened. It even happened going into the 81 recession as housing starts plunge, and that sent the unemployment rate higher, even through this double real dip recession of the 80s. Happened again going into the 91 recession, the dot-com bubble, the global financial crisis, and now we're set to see it happen even here because one of the problems for U.S. developers is they're sitting on the largest inventory since the financial crisis. And if we see the U.S. economy go into recession, well, that means there's going to be a lot of homes for sale and builders are going to aggressively slash prices, and that's going to drive, of course, the resale market down. And again, put a lot of people out of work at a time when every economy all around the world is desperate to keep their labor force intact, because once the labor force goes, it's game over. Chinese bank shares slump as earnings show margin profit pain. And talk about game over, it's going to be game over for Chinese banks as we see that they're already under pressure after China stepped up monetary stimulus late last year, lowering rates applied on loans and mortgages. But again, one thing I want you to think about here and why lowering rates doesn't work, because the Fed tells us, hey, we're going to lower rates when things get bad. But why doesn't it ever do anything? It's very simple. People that are out of work, they can't get loans. It makes perfect sense. Analysts are also worried that the escalating trade war will hurt the bank's overseas business. Analysts shouldn't even worry about the overseas business because, yes, that's going to get crushed. But the real issue here is all the leverage in the property market could blow up if prices continue to fall and people lose their job. Because the other thing that happens when business starts to slow down and people go out of work, well, they can't pay their bills. And that means the delinquency rate is set to rise. And we can see that again looking at some U.S. data. As the unemployment rate rises going into the 91 recession, what happens? The delinquency rate on consumer loans goes up right with it. We see the same relationship going into the dot-com bubble, again, the global financial crisis. And then once again, what are the projections from the Fed and a lot of other experts? Is the unemployment rate's going to go higher? And that means, of course, the delinquency rate also set to go up because just like Chinese consumers, American consumers are over indebted. And right now, what are we facing? A slowdown in demand for labor. We're hearing from a lot of these regional Fed surveys that hours worked are going down. Some jobs are going to get cut. And if things continue to slow down, both are going to get worse. China will lower reserve requirement ratio and interest rates based on domestic and international economic situation, that to ensure ample liquidity from the PBOC. Regardless, liquidity means nothing here because if people don't have jobs and they don't pay on their loans, well, it doesn't matter how much liquidity you inject into the banking system, it's going to get eviscerated. We've seen this before. And again, now let's turn to the U.S. data because I want you to understand again, it's all about the labor market here. If you don't have jobs, if people aren't making money, they're not going to borrow money. And in a consumption-based economy, borrowing money to buy things you don't need is absolutely critical. And we can see that as we look at the commercial industrial lending data of the U.S. against the unemployment rate. And what happens as the unemployment rate rises, demand for loans plunges and contracts. And you tend to see that go right in line with recessions. And it makes, again, perfect sense because we're a consumption-based economy. We need to see people borrowing money and spending it into the economy because then money multiplies and gets spread throughout the economy and leads to growth. That's exactly how the system works. And when we see a slowdown or even worse, a contraction like we did in 91 due to the recession there, well, it puts us into a dangerous situation. By 2001, we call that the dot-com bubble. Then we have the global financial crisis. And now, and you can see lending is just above the zero bound. And if we see the unemployment rate rise, that means it's likely to contract. And here's the problem, because in a debt-based economy, money's created when commercial banks create a new loan. But the problem is money's destroyed when a loan goes into default or when principal payments are made on the loan. So when you see a contraction in lending, that's why we see recessions almost every time. And what we're seeing now from the U.S. data is that odds of recession here are rising and quickly. U.S. firms added 62,000 jobs, the smallest gain since July in ADP data. Keep in mind, we'll get the official data on Friday. The ADP report showed mixed figures on wage growth as workers who changed jobs saw a 6.9% increase in pay, while those who stayed saw a 4.5% gain. And of course, this is based on 25 U.S. private sector employees. And here's the problem, though. What we're seeing in the data is just an indication that the unemployment rate is set to rise. Because if you think about it, if you're an employer and you're seeing demand go down, you don't have to give your employees big raises. But here's the other factor. If you're seeing the unemployment rate rise, it means there's available workers on the unemployment line that you can go get, so you don't have to pay your workers a whole lot more to stay because they realize there's no other opportunity if they lose their job. And we can see when average hourly earnings, this is production and non-supervisory employees in blue, decelerates as it did going into the 91 recession. It matched perfectly with a rise in the unemployment rate. And we can see that happen again going into the dot-com bubble. It happened a third time going into the global financial crisis. And right now, what are we seeing based on ADP is the average hourly earning rate is going to continue to decline. And what that's telling us that at some point in the near future, the unemployment rate is set to rise. And so now you can see why what's happening in China is a warning to the rest of the world, because we're seeing it happen here in the US. We're just a little bit behind them. And consumer spending, which accounts for 2/3 of GDP, advanced at a 1.8% pace, the weakest since mid-2023, but still better than economists forecast. A gauge of underlying demand in the economy was solid, helped by the fastest growth in business equipment purchases since 2020. Of course, we know a lot of this was front-running the tariffs, so what can we expect in May, in June, and July's data? Well, we can expect that number to plunge, and along with that, we can largely expect the unemployment rate here is going to rise as well. Several surveys of consumer attitudes have plunged, raising doubts about the ability of households to provide much fuel for the economy. Low-income consumers are already facing hardships of high prices, but this isn't new. We've been hearing from low-income consumers for months on months that they can't afford higher prices, and yet prices keep going up. And what's their problem? Is their paychecks are shrinking relative to inflation. They're not getting the hours. Some of them are losing their job. And so for low-income consumers, this is an absolute nightmare scenario. But even for wealthy people, it's a problem, because they've been set back by this year's drop in stock prices. Of course, we know that wealthy people tend to spend when the equity markets go up, but what did we see even when the stock market was at elevated levels? We saw from companies like Walmart saying that wealthy people were trading down, they're shopping at Walmart. It's just a strong indication that what's happening, not just in China's economy, is happening here in the US economy, and the pain is about to get real. So now you understand why what's happening in China is a massive warning to the world that chaos, and over the next couple months, is coming, and fast. But just because the global economy is about to plunge doesn't mean your trading account has to go with it. Let's check out that trade on GBTC. That's Bitcoin. We put that out to our Momentum Timer Pro subscribers as of close of business on April 30th. That trade is now up 12.18%. Let's check this out, because how do we do this? Well, each and every day we look at the technical indicators, things like the RSI and the MACD, and we aggregate them together, but then we overlay the trend, because what we found out is just buying oversold conditions in a downward price trend doesn't actually work. And that's what gives us the edge, because when you move out of oversold conditions with price behind you, well, you get amazing trades. We call that Momentum Timer Pro. Again, we look at the broad equity, bond, currency, commodity markets each and every day, and we run our screens on a 1 day, 1 month, 3 month, and 6 month window, and we built in all of our historical modeling, so when we see a high probability trade come through, it flags on our report. And here's what you get. You get the daily report. You get all the tradable signals, our hot list, and our regular signals. You get my opinion on the best trades. It's right, I review each and every one of them. We give you risk control levels, full tracking of all open trades and returns, and a weekly update. But here's the best part. We don't want you to pay a dime for your first month. All you have to do is grab the links in the description below and use that coupon code, and then you'll get a 30-day free trial. Why do we do that? Because we're so confident that you can make money trading our reports that we want your first month to be on me. I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.